Good evening, everyone. I hope you all had a very nice day. Can you all hear me? Let's just have a quick sound check. Do you all see the PPT? Can you all hear my voice? Okay. All right, thank you very much for joining this webinar. Actually, today we start a series of webinars that are going to be dedicated to market structures. There are 4 primary market structures that our students need to know, which are perfect competition, which is the benchmark, monopoly, which is at the other end of the spectrum, and in between we have 2 models of imperfect competition, which are monopolistic competition and oligopoly. So this series of webinars, I don't know how many webinars we will need to go through all this content. There is a lot to be said about this particular part of the syllabus. We might need 6 to 8 webinars to cover everything. And today, what I'm going to do is to introduce the concept of market structure itself. I think you should do that before you start teaching competition. And we will go through the definition of what perfect competition is. We will try to understand the shape of the individual demand curve in perfect competition. And if we have time, otherwise we'll do that tomorrow or the day after tomorrow, I will explain and give you some strategies on how you can teach the equilibrium in perfect competition. How do we move from short-term equilibrium to the long-run equilibrium? Okay, so today we should be together for about an hour. And again, if you have any question, I will keep an eye on the chat box. So if there is anything you want to say, anything you want to ask, you don't have to wait until the end. You can just say it whenever you have something in mind. Okay, all right, let's do that. Let's start with this introduction to market structure. So perhaps even if it sounds too easy or even silly, it's always good to remember what the definition of a market is. Market is a place where buyers and sellers, they meet at a given point in time to trade goods and services. Okay, it's always good to be able to define all concepts, even the easiest ones. And what do we call a market structure? It's simply the way this market is organized. What are the characteristics of this place where people meet, buyers and sellers, to trade goods and services? And when you define a market structure, when you describe a market, there are several things that you should tell. And these will be the characteristics in which we are going to be interested in. First, if you want to describe a market, of course, the first thing that comes to your mind is to tell how many buyers and sellers you have and their respective market shares. Okay, that's a key information that we are going to use to differentiate different market structures. Then, apart from that, you need to tell whether there are any barriers to entry or exit. Is there any obstacle that prevent or deter firms from entering the market, or obstacles that make it difficult for existing businesses to leave a particular market? I will give you more information about each of these items later. Also, a very important information when you describe the market, it's about the type of good that is traded. Do all firms sell the exact same product, or is the product differentiated? And again, we know that, for example, in monopolistic competition, there is a differentiated product, whereas in perfect competition, the product is homogeneous, it's the same. It's actually the only difference between perfect competition and monopolistic competition. And also to the extent to which sellers have control over price. Are there price takers, which means that whatever they do, they have no influence on the market price, or are there a price maker, which means that their behavior, their decisions are going to have an impact on the market equilibrium, on the market price. So I wrote sellers because for A2 and even an IG, we only care about the market power of sellers, but you could also have buyers which are a price maker. This is the case when we study the labor market. When we study a monopsonistic labor market, sellers are price takers, but buyers are price makers. Okay, right, and that's about it. You could add information. We have perfect information, imperfect information, but again, regarding the 4 primary market structures that we need to study, we always have perfect information. So we don't really need to talk about that right now. Okay, now let's have a closer look at each of these items. We have 4 items, so let's say a few words about each of them. So about the number of firms, buyers and sellers, but in particular it's focused on the number of businesses within the market. You know that we use concentration ratios to measure whether the market is concentrated, which means that there are very few firms who hold most of the market shares, or whether the market is not concentrated. You can say that it is atomistic when there are many small firms. Each of them has very small market shares. This is part of the A2 syllabus, and students must be able to calculate concentration ratios. And in particular, what we usually do is we calculate the N firm concentration ratio. So N is just the number of the N biggest firms. So for example, if you take the 4 firm concentration ratio, what you are going to do is simply to add the market shares of the 4 biggest companies in this market. If you calculate the 5 firm concentration ratio, you do the same thing, but with the market shares of the 5 biggest companies. So you can do that. It's very intuitive. And of course, the higher it is, the more concentrated your market. So a high concentration ratio indicates that firms are likely to have a strong market power in this particular market. A low concentration ratio suggests that these firms, the firms in the market, have a low market power. It's not always the case, but it tends to be. It's just an indicative. Okay, good. All right. Yeah, as I say, it's not always true. It's possible that even if you only have 2 firms in the market, they might be competing very aggressively. This is the example of Bertrand competition. So we have to be careful when we try to interpret these concentration ratios and to determine whether firms actually have market powers or not. It's difficult to make conclusions sometimes. All right. I don't want to say too much about that. You can share these examples with your students. I like this example because you see that when you compare these 2 markets, and if you ask your students, look at these 2 markets and let me know which one you believe is the more competitive. Students might tell you that market 2 is more competitive simply because you have 5 firms. Each of them have the same market share. So you have 5 firms of similar size. So it suggests that each of them will compete very aggressively with each other. On the other hand, if you look at market 1, you see that you have just one big company that seems to be dominating the market. We actually call that a dominant firm market. And then you have many smaller firms. So it suggests, when we look at that, we are tempted to believe or conclude that market 1 is likely to be less competitive than market 2 because you have this dominant firm. But if you compute the 4 firm concentration ratio in the 2 markets, market 1 and market 2, you are going to find 80% in both cases. So you see, even though it seems like these markets, that firms have different market power in these different markets, but the 4 firm concentration ratio does not give any information, does not show the differences between these 2 markets. So we have to be careful when using this indicator. The alternative, but this is not tested in A2, is to use the Herfindahl-Hirschman index. But you see you have this 1 step further star, so I'm not going to talk about that tonight. but you can have a look at the PPT if you want. Of course, you can download it from my website. What I suggest you to do is to use real data. It's very easy to find information about market shares in certain markets. So, for example, you have shares of China's business to customers online shopping website by, I think GMV is general market value, I'm not sure. So this is the data from 2016. And then you can just look at different markets. I have the market for smartphones, for example, in China. Do that, find some data so your students, they can discuss whether different markets are relatively concentrated or not. I also have the example of airline market, again in China, for China-US flights. You can choose any market for which you think your students will have a particular interest. You can even ask them to find the data themselves as homework and to compare different markets to calculate concentration ratio. Okay, this was the first point, the first item about the number of firms. The second item that describes market structures is about the existence of barriers to entry and exit. So let's focus first on barriers to entry. Your students, they must be able to explain what they are, how to define that, and to give examples of different types of barriers to entry. So they don't have to know 10 different examples, but at least 3 possible examples of barriers to entry. First, how do we define it? It's any obstacle which deter or prevent new firms from entering the market to compete with incumbent firms. This means the firms who are already in the market. And there are many different reasons, so many different types of barriers to entry. So let me just give you an outline of the different types of barriers to entry. Of course, you can have high startup cost. It might be very expensive to raise enough financial capital to start that business. Only very large companies can do that. You could have a monopoly access to raw materials when there is a key resource that you need to produce a particular good or service, but if it's not available, if it's under the monopoly control of one of your competitor, then even though you can theoretically enter the market, if you don't have access to a key or critical resource, then you will not be able to produce the good or service. So this is another reason for which it might be difficult for firms to enter in a particular market. You have the typical example of economies of scale. Usually when you start your business, when you enter a particular market, you will start at a low scale of production because it takes time to build up, to increase your market share. And you will compete with firms who have been in the market for a long time, which suggests that they have a much larger market share than you, at least when you start your business. The problem is that if you are in a market with substantial economies of scale, the fact that your competitors have a much bigger market share will allow them to produce at a much lower average cost than you. So the consequence is that you will try to enter, but then your competitors will underprice you. They will charge a price that is above their average cost, but below yours. This is an example of predatory pricing. So they will keep prices low until you just go bankrupt. So, and if you anticipate that, you might choose not to enter the market to begin with. Legal barriers to entry, this could be copyright, patents, licenses, public monopolies, of course. Not much to say about that. It's rather straightforward. What else? High sunk cost. If you anticipate that if you go bankrupt, that there will be a lot of expenses or lots of costs that you will not be able to recover, then you could put it this way. It means that entering the market is very risky, because if you succeed, all good, but if you go bankrupt, if your business does not work, you will lose a lot of money. And if you are sufficiently risk averse, which means if you are afraid of taking a risk, this might be sufficient if there are high sunk costs for you to choose not to enter a particular market. What else? Limit pricing. This is a situation where the firms inside the market, they charge a low price to pretend that this market is not profitable, that it's not worth it for other businesses to enter this particular market because the price is very low. So it's one way to deter new firms from entering the market. What else? Marketing barriers to entry. If we are in a market where brand loyalty is very important, then it might be very complicated for new firms to enter, because even though they produce new goods and new services, even though they offer something different, it's going to be very difficult to poach consumers from other brands, from other businesses, simply because they are loyal to the product that they have been purchasing for a long time. In other words, you could say that the cross-price elasticity of demand is very low. Even if you decrease your price, consumers, they will stick to the brand that they have been purchasing for a long period of time. Okay, I'm not going to talk about network externalities because it's a bit more advanced. All right. And of course, a business will enter a market only if the benefit of breaking down those barriers is greater than the cost of breaking down those barriers, like a cost-benefit analysis. Examples of barriers to exit, there are much fewer examples that we can give. So it's the opposite. These are obstacles that make it difficult for a firm to leave a market quickly and at little cost. The first reason for which it might be difficult for firms to leave a market will be the redundancy cost. If you want to leave a market, you might have to terminate contracts. And in this case, you make your employees redundant, and you might have to compensate them. It might be extremely costly for you to compensate your employees if you break the contract that you have with them. Another example is the high investment in non-transferable fixed assets. Let me give you a simple example. If you are a transportation company, so you have a lot of trucks, if you go bankrupt, it's not very difficult for you to sell your trucks to another transportation company, right? In this case, we would say that the trucks are transferable fixed assets. It's easy for you to resell them. So when you buy your truck, it's not a sunk cost because it's easy to sell it. But on the other hand, there are some companies that use very specialized capital equipment, and when they go bankrupt or if they want to leave a particular market, they cannot resell this equipment to anyone. Think of I don't know, a company that produces watches, luxury watches. And these companies, they have very specific models of watches. So they have to design specific machines and specific tools to produce each model of watch. If you know the Swiss company Patek Philippe, which is a company that produces very expensive Swiss watches, they produce tools and machines that can only be used to produce one specific model of watch. So if they want to leave the market or if they go bankrupt, there is no way they can sell these machines and these tools to anyone else. These are non-transferable fixed assets. In this case, it's a pure sunk cost. There is nothing you can do to recover the cost of purchasing or producing these tools. And there might also be contract contingencies with suppliers or buyers. If you are a business and you have committed to purchase raw materials for a duration of 2 years, for example, and then you choose to break the contract after 1 year, same thing, just like you might have to compensate your employees if you break their contracts, you might also have to compensate your suppliers or even your buyers if you break a contract or terminate a contract that you had with them beforehand. Okay, so these are basically cost of leaving the market. Good. All right. So that's all about the second point. That's all about barriers to entry. What can we say about product differentiation, which is the third information that we have to say about the market when we describe it? What is it? Product differentiation is simply a situation where the businesses in a market, they sell products that are similar but not identical. Careful. You should not say that a car and a guitar are differentiated products. They are completely different products and they are sold in different markets. Okay? So that's why the definition mentions that the products have to be similar, but not exactly the same. So this could be a different brands of watches, Mercedes-Benz versus BMW, Pepsi versus Coca-Cola. Okay, you can give plenty of examples. The opposite of product differentiation is what we call standardization. In a market where the output is standardized, all firms sell the exact same product. We say that the output or the product is homogeneous. In that case, consumers, they don't care about whether they buy from seller A or seller B, because both sellers, they sell exactly the same product. So consumers, they will regard these two products as perfect substitutes, and something that is very important, especially when we will start talking about perfect competition. In this case, the only thing that matters to the consumer is the price. Nothing else matters, simply because there is nothing that differentiates the product. So buyers, in this case, they will always purchase the good or service from the business that charges the lowest price. There is no other dimension that the consumer can use to determine or to choose where to buy the product. Okay. On the other hand, if you are in a market where products are differentiated, then these different goods and services provided by different companies, they are imperfect substitutes. They are not exactly the same. And in this case, price is not the only selection criterion. So, for example, if I have, let's say, a blue pen and a red pen, it's a stupid example, but okay, it's worked. So a blue pen and a red pen, these are differentiated products. And let's say that blue is my favorite color. Well, even though the blue pen is more expensive than the red pen, I might be willing to purchase the blue pen simply because I like the color better. Okay? But if I had to choose between two blue pens from two different businesses that are exactly the same, then the only thing that would matter to me is the price. And I would buy from the business that sells the blue pen at the lowest price. Okay? So the consequence is that some consumers may choose to purchase from firm A rather than from firm B, even if firm A charges a higher price, simply because these consumers, they prefer firm A's product. Okay, it's very important. And why do firms seek to create product differentiation? Simply because it creates market power. It reduces the intensity of competition. Basically, the closer the products, the more intense competition and the lower the market power. The more differentiated the product, the less intense competition and the greater the market power that each company has. All right, good. So then product differentiation makes businesses price maker. It is through product differentiation that businesses can influence the price of the good and service that they sell. You see, in perfect competition, we'll talk about that all businesses are price takers, but in monopolistic competition, and again, the only difference is that the product is differentiated, all businesses are price maker. So product differentiation creates market power and gives the ability to firms to influence the price. Okay, last point, and then we can talk about perfect competition. What does it mean to be price taking? What does it mean to be price making? So here I will only focus on businesses, but remember that even buyers can be price maker and price taker. So price taking, a price taking firm is simply a firm whose actions cannot affect the market price of the good or service itself. In particular, it does not matter how much output I sell 1 ton of wheat or 100 tons of wheat. the market price is going to be exactly the same, simply because I am so small compared to the entire market that my decisions are irrelevant. They are so small that they have no influence on the overall market equilibrium. Okay, and among the 4 market structures that we are going to study, it's only in perfect competition that firms are price takers. In all 3 other market structures, businesses are going to be price maker. Okay. And the opposite of being price taker is to be price makers. Of course, in this case, it means that businesses, they have some market power that they can use to influence the market price. So depending on what they do, the market price is going to be influenced. So in a monopoly, if the monopolist wants to sell a low level of output, it will be able to charge a high price. But if the monopolist intends to sell a higher level of output, it will have to charge a lower price. So they have some scope for influencing the market price. In this case, it means that the more you want to sell, the lower the price that you will have to charge. So you will face a downward sloping demand curve. But I don't want to go too fast. I will talk about that when we will compare perfect competition and monopoly. Okay. And yes, in monopoly, monopolistic competition, and oligopoly, in these 3 market structures, firms are price makers. Very important to keep this in mind. So 4 market structures, ones that we will study together during these webinars. We will follow this order, which is the common or usual order to study these market structures. And at the end of this introduction, again, what you can do with your students is to give them this table, this blank table, and to ask them to fill it. Okay? So you have the 4 main characteristics of any market structure: number of firms, whether or not we have product differentiation, whether or not firms are price taker or price maker, and whether or not we have barriers to entry or exit. And then you have the 4 primary market structures, and you can use that to summarize or to introduce these 4 primary market structures. So in perfect competition, many businesses, they all sell the same product, they are all price takers, and there is no barriers to entry or exit. In a monopoly, we only have 1 firm. Well, the concept of product differentiation does not even make sense. It's not applicable because we have 1 single firm selling 1 single product. They have, the monopolist has a considerable control over price, a strong market power, it is price maker, and barriers to entry are prohibitive, which means that they are so high that nobody can enter into this market. Monopolistic competition, many firms, just like perfect competition. There is product differentiation, which gives some control over price to businesses. So firms are price makers. Of course, they don't have as much market power than in the case of a monopoly, but they have some control over the market price. And there are no barriers to entry or exit in monopolistic competition. In oligopoly, last market structure, there are only a few firms. So what does a few mean? It could be from 2 to 10, I don't know, something like that. There is no clear limit. The output could be differentiated or it could be homogeneous. There are 2 different models. They are what we call differentiated oligopolies, and they are homogeneous oligopolies. The extent to which firms are have control over price, it depends on many parameters. It varies a lot, depends on whether there is product differentiation or not. It depends on how many firms there are in the oligopoly. It depends on how they compete. Do they compete in price? Do they compete in quantity? Is there another way in which they can compete? Non-price competition, for example. And there are considerable barriers to entry or exit. It is expensive for businesses to break down the barriers to entry to enter an oligopoly. Good, and this is not very, this is a bit more advanced, it doesn't really matter. Good. All right, so I'm done with the introduction. Do you have any questions before we move on and we start talking about perfect competition? Are we good? Any questions? Load the new PPT. Are we ready to move on? Yep. Okay. So let's have a look. Do you guys see the new PPT? Yes, on perfect competition. Can you just confirm so I don't start if you cannot see the new handout? Do you all see the perfect competition PPT? All right. Okay. All right. So many things that our students are expected to know about perfect competition. Let me try to summarize the main ideas. They must know how to define the characteristics of perfect competition. We've already done that, so it's okay. They need to be able to graph it, to graph the short-term and long-run equilibrium, and to explain how it works. They must be able to explain, to talk about efficiency, to discuss the concept of efficiency in perfect competition. They must be able to talk about the supply curve, to say to identify the market supply curve, the individual supply curve, and in AP. But this is not for Cambridge, but for AP, they have to know the difference between increasing cost industry, constant cost industry, decreasing cost industry. I think these are the main things that that our students need to know about perfect competition. So today, I'm not going to do everything, of course. I will only introduce the characteristics of this market structure, and I will spend some time to explain the shape of the individual demand curve. All right, let's do that today. So characteristics, we've already talked about that, and so I'm not going to repeat myself. What you can tell your students is that, of course, this is a theoretical model. It does not exist in the real world. There are no markets that are perfectly competitive. The typical examples of markets that we use to illustrate perfect competitions are agricultural markets, any like commodity markets like cereals. These are the markets that are the closest to perfect competition. But what you should tell your students is that even though perfect competition is a theoretical model, it does not mean that it's useless to study it. And the main advantage of the reason for which studying perfect competition is useful is because we can use it, this is what I explain here, we can use it as a benchmark against which alternative market structures can be examined. So we study perfect competition, theoretical model, we study real-world market structure, and then we can compare the outcome. We can compare the price, the output, and so on. And you can ask them whether they do these type of things, like this theoretical benchmark that are not realistic, but that are useful as a benchmark in other subjects. And they might tell you that in science, they do use this type of theoretical benchmark. So for example, in science, there is notion of an ideal gas, which is exactly the same thing. An ideal gas does not exist in the real world, but it does provide a benchmark that is useful when we study real gases. That's an example, you can connect different subjects to justify, to explain why this theoretical benchmark is important. All right, so let's try together to understand the shape of the individual demand curve in perfect competition. You know that the individual demand curve is horizontal, but why is this the case? Let's try to understand that together. And we are going to do that step by step. And I'm going to ask 3 different questions to understand the shape of this individual demand curve. First question, what happens when a perfectly competitive firm charges a price above the market price? You know how this works. You have the market supply, the market demand that will determine the market price. Let's say it's $10. And then you have these many small individual firms, and they have to decide what price they charge. Because we say that they are price takers, but they can actually charge whatever price they want. I will explain the difference. So what if they say, okay, I know the price, the market price is $10, but still I will try to charge a price of $12. What's going to happen in this case? Well, as I said, each individual is very small compared to the market, so they have no influence on the market price. So what's going to happen if they charge a price above the market price? The market price is $10 and I try to sell my product at $12, because there is perfect information in that market. So buyers know that the market price is $10. They know that everybody else is selling the product at $10. And because every sellers, they sell exactly the same product, if I try to sell my product at a price above the market price, I will face a demand of 0. Nobody will be willing to buy the product from me. But above the market price, the demand to me is 0. This is again assuming that I am the only one charging a price above the market price. And in this case, we all understand that firms will never charge a price above the market price because they would not find anyone willing to buy from them. What happens if I charge exactly the market price? So market supply and the market demand determine that the market price is $10, and I say, okay, I am going to charge a market price of $10. Well, in this model of perfect competition, we make an assumption, and we assume that in that case, if I charge exactly the market price, I can sell as much as I want. So careful, this does not mean that I can sell any quantity. It means that I can sell any quantity between 0 and the total market quantity at that price, because even in a big market, when you have many sellers and many buyers, at one given market price, you do not have an infinite quantity demanded. You have a finite quantity demanded. So at that price, if you, as an individual firm, you charge exactly the market price, you can sell as much output as you want between 0 and the total quantity demanded at that price. I will illustrate that with diagrams. It's going to be much easier. You will see. Okay. It means that in this case, at the market price, my individual demand curve is horizontal, perfect elastic, to acknowledge the fact that I can sell as much as I want between 0 and the total market quantity. So it's represented by a horizontal line. And this is why we do not need, and this is why we understand that firms in perfect competition, they will never charge a price below the market price. Why? Usually, when firms try to cut the price, their objective is to increase the quantity demanded, to sell more output. That's the incentive, that's the reason for which they cut the price. But you see that in this model of perfect competition, I can sell as much as I want at the market price. So I have no incentive to charge a price below the market price. That's why at the end of the day, we say that perfectly competitive firms are price takers, because they will always charge exactly the market price on which they have no influence. Okay? Just to conclude this explanation, we can just ask the question, what would happen if, as an individual firm, I decided to charge a price below the market price? So again, the market price is $10, and I try to charge a price of $9. Well, in this case, it's interesting because if I am the only one charging a price of $9, everyone would like to buy from me, which means that at that price, I would face the entire market demand at that price. But because I am a very, very small firm in a big market with millions of buyers, I just cannot satisfy all these demands. So that's why, again, there is no incentive to charge a price below market price. That's what I explained here. The quantity demanded from a firm charging a price below market price is equal to the entire market quantity demanded at that price. Okay, so how do we represent that graphically speaking? And you'll see that we will understand the usual diagrams that we see in textbook a bit better. Right, let's represent the market. So we have the market quantity on the horizontal axis and the market price. I have the market supply and the market demand. Of course, market demand is downward sloping. This is not the individual demand, this is the market demand. So the forces of supply and demand will determine the equilibrium price, P star, and the equilibrium quantity, Q star. And then let's ask these three questions again. What happens when I charge a price above the market price? So if I try to charge a price above P star, nobody wants to buy from me. So my individual demand is 0. Okay. Above P star, this would be my individual demand, 0. If I charge the price P1, quantity demanded is 0. What if I charge exactly the market price, P star? Then again, by assumption, at that price, I can sell as much as I want between 0 and the total market demand at that price, Q star. Okay, so at P star, I can sell as much as I want between 0 and Q star, the total quantity demanded at that price. For example, a lowercase Q star. And finally, what happens if I try to charge a price below the market price? Then I would face the entire market demand because everyone in the market would like to buy from me. You see? So my individual demand would be the same as the market demand whenever I charge a price below P star. Okay? So when you think about it, this green shape, I don't know how to call it, is the individual demand of a firm in perfect competition. And this is actually how we should represent it. Okay? It's not just horizontal. Usually we only represent the horizontal section. I'm going to explain why. But this is the true shape of the individual demand curve of a perfectly competitive firm. Okay? Something like that. Market price, the demand is 0 above, and the demand is the market demand below. And then at P star, I can sell as much as I want. So why don't we represent this downward sloping section? Because you see, when we graph the individual demand curve, we don't see the right-hand part of this diagram where the demand becomes downward sloping. Well, simply because it's too big. It's a quantity that is too big for the business. Too big means that the cost structure of the firm is completely incoherent with the provision of such a high level of output. The firm cannot produce such a high level of output. So basically we have this relevant range of output. It's relevant given the cost structure to the firm, given the size of the firm, and all that is just irrelevant because it's too big, it's too large for this particular firm. So that's why we do not represent this downward sloping section simply because a very small firm in perfect competition cannot face or provide a quantity that is equal to the total market demand. So we just don't represent it. So we are left with this. We are left with this demand is equal to 0 above P star, and the demand is horizontal at P star. And usually by convention, we just don't represent it. Don't ask me why. I think it's a bit misleading, but by convention, we don't represent the perfectly price inelastic section of the individual demand curve. So we are left with this. And this is usually what we have in textbooks, just the horizontal section. But again, when you think about it, this horizontal section is just a part of this individual demand curve, which would be more complete. But the right-hand part is irrelevant, quantity is too large, and for some reason, we don't represent the vertical section. Okay, I think it's important. I think it's important to keep this in mind and to really understand how we build the individual demand curve in perfect competition. All right, now, how do we describe the equilibrium? And that's the last thing that I'm going to do today with you, the short-run, long-run equilibria in perfect competition. The first thing that is really important is to understand that the marginal revenue is equal to the average revenue, which is the price of the output. Remember that the average revenue is simply the price. Let me just, if I can just write something, remember that the total revenue is just price times quantity, all right? The average revenue is just total revenue divided by quantity, which is the price. Okay. I think you know that. The average revenue is just the price at which you sell your product. And the marginal revenue, it's the change in total revenue when you sell one more unit. And remember that in perfect competition, you do not need to cut the price to sell more output, which means that if you want to sell one more unit, you do not need to decrease the price. If you face a demand that is downward sloping, just like in monopoly, for example, the only way you can sell one more unit is by cutting the price. And you probably know, and we'll see that when we study the monopoly, that in that case, the marginal revenue is lower than the average revenue because you have to decrease the price on all previous units that you have already sold. But in perfect competition, you do not need to cut the price to sell more output. So every time you sell one more unit, your total revenue will increase by the market price. It's a fundamental thing that students need to know and they need to be able to explain it. Okay? Then, how do firms make decisions? The assumption that we make is that their objective is to maximize profit. And the profit maximizing rule is such that MC is equal to MR. I think your students will know that by now. So if in perfect competition, MR is equal to the price, then the optimum output rule is just MC is equal to price. Price is equal to marginal cost, or price is equal to average revenue. This is equivalent. It's going to be important to identify the optimal quantity, the quantity that maximizes the firm's profit. Okay, just erase. Oh, that's better. Now, we will assume all firms are the same. And something that is critical, very important to understand, is the definition of the short run versus the long run in perfect competition. You know, in economics, short run versus long run is a bit tricky because it has different meaning depending on the context. If you study production, then we would say that the short run is a situation where there are some factors of production that are fixed, and the long run is a time period where all your factors of production are variable. When you study perfect competition, the definition is not exactly the same. The short run is a situation where the number of businesses is fixed. And the long run is a time period where the number of businesses is variable. And if you when we study macroeconomics, when we study the short-run aggregate supply and the long-run aggregate supply, we have an even different definition of short-run versus long-run. In that case, the short-run is a time period where input prices are fixed, and the long-run is a time period where input prices are variable. So you see that short-run versus long-run, the definition depends on the context. When we study perfect competition and market structures in general, the short-run is about, do firms have sufficient time to enter and exit the market? In the short run, they can't. In the long run, they can. So in the short-run equilibrium in perfect competition, you have a fixed number of businesses. They maximize their individual profit by producing at MC is equal to MR or MC is equal to price. Now, you know that the movement or the transition from the short run to the long run depends on whether firms make positive profit in the short run, abnormal profit, or subnormal profit in the short run, negative profit. Let's see the two cases. First, let's assume that they make abnormal profit in the short run. In the long run, firms outside the market, they will be attracted by the existence of this abnormal profit. And because there are no barriers to entry, they are free to enter the market to benefit from the existence of this abnormal profit. But as more firms enter the market, when you have an increase in the number of suppliers, market supply is going to increase, shift to the right, and the market price is going to fall, which means that the profit that firms make in this market is going to decrease due to this lower market price. And this entry process will stop when all firms in the market, when they make exactly zero economic profit, which is the case when the price is equal to the minimum of the average total cost. We'll see that on the diagram. What if, let's consider the other case now. Firms lose money in the short run. They make negative economic profit, subnormal economic profit. In this case, the long run, when they have sufficient time to leave the market, some of them will exit, will leave the market because they lose money. And this will lead to a decrease in the market supply. Of course, they are free to leave the market because there are no barriers to exit. The market supply is going to decrease simply because there are fewer firms remaining in the market. And when supply decreases, the equilibrium price is going to rise. As the market price rises, the losses that firms make in the market are going to diminish, to become smaller and smaller. And this exit process will stop when firms no longer lose money in this market, when they make normal profit or zero economic profit, which again is the case when the price, when the market price is equal to the minimum of the average total cost. Okay. Now that we have the text explanation, and this will be the conclusion of this webinar, let's have a look at the diagrams. You know that these are side-by-side diagrams where we are going to represent the market equilibrium on the left-hand side and the firm's equilibrium, or a representative or a typical firm's equilibrium, on the right-hand side. So make sure your students label these diagrams properly. Should be price on the vertical axis, quantity. I usually add this unit just to emphasize the fact that the quantity in the market is much, much bigger than the quantity for a typical firm. And make sure your students write market below the diagram so the examiner knows what your students are representing. So this is the market supply, this is the market demand that will determine the equilibrium price. And here on the right-hand side, I have individual firm. Rather than price, I think it's better to write cost revenue rather than price, but it's no big deal. And you see that here I also add the unit thousands, just again to emphasize that these are not the same units, that this individual firm is very small compared to the overall size of the market. So what do we have? We have the market supply and demand that will determine, sorry, first the cost curves, marginal cost, and average total cost. And the market supply and demand determine the equilibrium price, P1, and the equilibrium market quantity, Q1. Then once we have this price, we have the individual demand curve. Okay. Again, we could add this vertical section if you want. We could, okay, let's see if I can add it. Just to review, okay, don't forget that there would be this vertical section right here, even though by convention we don't represent it. And then if we continued very, very, very far to the right, let me try to do it. If we continued very, very far, okay, up very far, we would actually have this downward sloping section. Yeah, this would be the total market demand, but that's so far that it's irrelevant. Okay, now, so that's the individual demand curve. This individual firm wants to maximize its profit. So it's MC is equal to MR. MC is right here, MR is right here. So the equilibrium quantity, boom, right here, Q1. Let's see if this firm is making a profit or a loss. So we need the ATC. For this quantity Q1, the average total cost is right here, ATC1, and we see that this area represents a positive economic profit, abnormal profit. This is a short-run equilibrium. Firms, there is a fixed number of businesses in this market. Now, what is going to happen in the long run? Firms outside the market, they see that, hey, this market is profitable. We can make profit in this market. Let's enter. Can we do that? Yes, there are no barriers to entry. So more firms are going to enter this market, leading to an increase in the market supply from S1 to S2. The consequence is that the market price is going to decrease from P1 to P2. The market quantity is going to increase. We are going to have a new individual demand curve. R2 is equal to MR2. And you see that now with this new individual demand curve, this individual firm keeps maximizing its profit. MC is equal to MR. So now the optimal quantity is Q2. In that equilibrium, you see that the firm is making normal profit because the price is equal to the ATC. Something that is interesting that you can ask your students is to say, hey, look, there is something weird. You see, in the market, when supply increases, the total output increases from Q1 to Q2. But if we look at this individual firm, you see that it produces less. How is this possible? How is it possible that in the market we produce more if each individual firm produces less? And usually the good students, they find the answer, which is simply, yes, each individual firm produces less, but there are more of them. Firms have entered, so the number of firms have increased. So even though each of them produces less, overall, they will produce a larger output. Okay, let me erase that. All right, and the other case, I'm going to go very fast. The other case is the opposite. Boom, 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 boom. When in the short run, each individual firm makes a loss, loses money, negative economic profit, the price is lower than the ATC. The price is lower than the minimum of the average cost. You can put it this way. In the long run, when firms have sufficient time to exit the market, some of them will leave the industry, leading to a decrease in the market supply. And the decrease in the market supply is going to make the market price increase from Q1 to P2, and the market quantity will fall from Q1 to Q2. Each individual firm is now going to face a new individual demand, AR2, MR2, which is equal to the new market price. And they will keep maximizing their profit when MC is equal to MR, which is at the quantity Q2. And here they no longer make a loss, they make normal profit because the price is equal to the average total cost. And same question as before, hey, look, even if in the market we produce less overall, but each individual firm produces more, but we have fewer of them. Again, so even though we have each firm produces more than before, because we have fewer firms than before, overall, the market output decreases. Okay, and that's it for today. Do you have any questions? Are you still alive? Is this okay? Do I go too fast, too slow? Is there anything else you would like me to, anything you'd like me to adapt to better meet your expectations? Any questions? So Crystal, I just Googled it. I probably typed, I think actually what I did is that I used Google Images and I typed something like market share pie charts. And then you can just type some, yeah, okay, let me try to, but I don't have my VPN on, but instead of looking at the data, you can search images of pie charts. So you can type any smartphone, market shares, China, and you will have pie charts. Same thing, airline industry. I think that's going to be the easiest way to find data about market shares, and mine are not up to date. I think that they date back to 2017 or 2016, so you can probably find data that is more recent. Carly, could you repeat short run and long run in economics? Yes, of course. So generally speaking, the short run is a situation where something is fixed, and the long run is a situation or a time period where what was fixed in the short run becomes variable. So then, depending on the context, what is fixed in the short run can change. When you study production, what is fixed in the short run is the quantity of at least one factor of production. If we simplify, if we consider that we only have two factors of production, capital and labor, the usual assumption that we make is that in the short run, the quantity of capital is fixed and it only becomes variable in the long run. But if you look at perfect competition and market structures in general, it's not really about input. It's not really about, can we change the quantity of capital, yes or no? Instead, it really is about businesses, the number of businesses. In the short run, the number of firms inside the market is fixed, which again suggests that they don't have enough time to enter or leave the market. And this number of businesses becomes variable in the long run, a time period where we give sufficient time for businesses to enter or exit the market. And the third situation where we distinguish between the short run and the long run is when we study the aggregate demand, aggregate supply classical model, when we say that wages are sticky in the short run. Wages and other input prices, they are sticky in the short run and they become variable in the long run. So in this case, it's not about an input, it's not about the quantity of an input, it's not about the number of businesses, it's really about a price that is fixed in the short run and that becomes variable in the long run only. So again, generally speaking, in the short run, something is fixed. In the long run, what was fixed in the short run becomes variable. I hope I answered your question. Well, which version of course book is the PPT content referred to? I have used, I'm not sure I understand your question, Crystal, but I have used many different textbooks to prepare those PPTs and textbooks and other sources. I have used 3 textbooks that are endorsed by Cambridge. I have used the book by Terry Cook. I have used the Bamford, and the one from Harder Education, the Peter Smith. So these are the 3 primary textbooks that I have used to design these PPTs. But I have also used a lot of resources, YouTube videos, resources like Marginal Revolution University, resources like Khan Academy, many different websites, and my personal knowledge as well. So these PPTs are really are a combination of many different types of resources. I was saying the short run and long run are not about the quantity, but the price of act. It depends. It depends on the context. Again, in microeconomics, when we study production, it's about the quantity of a factor of production. Yes, capital is fixed, labor is variable, no problem. The quantity of capital is fixed, the quantity of labor is variable in the short run. But for example, in macroeconomics, when we distinguish the short run and the long run in the ASAD model, it's not about whether a quantity of input is fixed or variable. It's about whether the price of inputs, all of them, but mostly labor, are fixed or variable. Remember, when you study the short-run aggregate supply curve, the short-run aggregate supply curve is upward sloping because wages are sticky in the short run, wages and other input prices. So if the price level increases, okay, let's put it this way, that's usually what I do with my students. If the price level increases, I'm going to stop sharing my screen so then in the video we'll be able to see what I'm trying to do, all right? So if the price level rises, but in the short run wages are fixed, so you want to supply, firms want to supply more output simply because their cost of production is the same, but they can sell their product at a higher price. So it's profitable for them to sell more output, okay? And same thing, if the price level decreases, but wages are sticky in the short run, they stay relatively high, then their cost of production remains quite high, but now they can sell their products at a lower price. So their incentive is to supply less output. It's less profitable to supply less output. So that's actually how we can explain why the short-run aggregate supply is upward sloping. It really is about whether the price of inputs changes in the short run or not. And in the short run, they are fixed. They are sticky. They can only change in the long run. So you see that in this case, in the context of the ASAD model, the difference between short run and long run is different from the difference between short run and long run in the context of production. And it's different from the difference between long run and short run in the context of market structures. I hope I'm clear. So summary, in production, short run, long run is about the quantity of factors of production. In the context of market structures, short run, long run is about the number of businesses in the market. In the context of ASAD, short run, long run is about the price of factors of production. I hope this summarizes these differences well. Can I explain why perfect or imperfect information is not added to the characteristics of market structure? Because in perfect competition, there is perfect information. In monopoly, there is perfect information. In monopolistic competition, there is perfect information. And in oligopoly, there is perfect information, at least in the simplified models that we study in high school. So since we always have perfect information in all markets, it's not useful to, it's not something that we use to differentiate these 4 market structures, because it's all the same. We always have perfect information. It's like if you would say one characteristic is profit maximization. Yeah, okay, but in all 4 market structures, we make the assumption that firms make decisions to maximize profit. So it's not one characteristic of a market. It's not something that helps us distinguish one market structure from the other. So that's why it's not usually not useful to explain, to give information about the information in the market when describing the market. Anything else that is not perfectly clear? No more questions? How about the time of these webinars? Is it okay when we meet in the evening like that? Is this too late? Too early? Is this suitable for you? Okay, good. All right. Okay, perfect. So this, the recording of this webinar will be available on my YouTube channel. It will be available on my website, and it will be available on my Facebook group as well. So if you want to watch it again, you can access it very easily. I think tomorrow night I will be able to organize the part B of this webinar on perfect competition. So I will share the information with you tomorrow. And the objective tomorrow will be to finish perfect competition. Yeah, we should be able to do it. We need to talk about shutdown price, exit price, efficiency, supply curves. We should be able to finish that tomorrow. So then we can move on and talk about monopoly. All right, thanks everyone for joining tonight. Have a nice evening, and hopefully, what's my YouTube name? It's just EconDoctor. If you log into, if you visit my website, you probably have the address. At the bottom of the welcome page, there is a link to the YouTube channel, so you can subscribe. And there are not so many videos yet. There are about 20 videos at that stage, but I plan to add new videos every week, so hopefully there will be much more in a couple of months. All right, thanks again. Have a nice evening, and talk to you tomorrow, hopefully. Bye-bye, everyone.